We return from the Thanksgiving holiday lull to find markets idling. Not a whole lot going on here, but that may or may not mean that the year is over. We do, of course, still have a whole month to go. And although we have started the holiday season, there are still things to be concerned about, and there are still things on the calendar that could move these markets. Welcome. This is, of course, Macro Money. I'm Ilias Pivac, head of Global Macro here at tastylive. And that is the question that we are going to concern ourselves with today as we look out to what could be moving markets in the week ahead. Have we settled into autopilot at this point? Have we seen everything that there is to see that is going to shape the trends in these markets in any kind of a formative way? Or are we just coasting now? And so we'll begin with a look at how things shaped up last week performance-wise, and there are some telling things that we can see here immediately. So on the stock side of things, be it the catch-all S&P 500 or the more high-flying and, of course, outperforming NASDAQ this year, things generally looking like cautious continuation. So S&P up just under 1% after an over 2% gain in the prior week. NASDAQ comparably up about 0.8% after a nearly 2% week the prior go around. So looks like slow continuation. In the bond market, digestion. We had massive declines in yields the week before last. So last week we had a little bit of a correction. Doesn't seem like there's very much to see there. And the commodity space, seemingly speaking of ebbing geopolitical risk premium, as much as anything else, as the markets apparently conclude that this situation in the Middle East is not going to spill out beyond the immediate two combatants. And so we have crude oil down for the fifth week, albeit modestly, down 0.7%, so a little bit less than the prior week's 1.5% decline. Gold, interestingly, performing very modestly in an environment where the dollar is down. We can see the euro here as a stand-in for the dollar. It's up about 0.3% last week. That's after a 2% gain in the prior week. And we get a sense that gold, even though it should be finding perhaps some relative support, because, of course, a stronger euro, the dollar's most liquid counterpart, would tell us that the dollar itself is getting sold. Gold seemingly finding a little support there, but not a whole lot. And the modest gains occurring even as we get a rise in yields. So the typical catalysts for gold, the direction of the dollar, the direction of yields, seemingly not having a tremendous influence. And although we get a little bit of a gain, we get it very much within the bounds of the recent range over the past several weeks, to sort of echo this idling around geopolitics filtering out of the market. And so relatively muted action last week, but of course we did have the holiday, and that drained liquidity. Sometimes that can be an amplifier for volatility if something really explosive occurs, but that doesn't seem to have been the story. That does not mean that we are not going to have anything that moves things this week, of course. And there are still ample opportunities to shake things loose, especially as we get, with the passing of Thanksgiving and the sort of ramp up into the end of the year and the winter holidays, where even more markets are going to go offline. There's a general sense of a liquidity that is going to be with us for the next 2-3 weeks, as that transition occurs. And so we still have economic data. It still has bearing on expectations, but liquidity is probably not going to truly rebuild in all of its robustness, maybe until next year. And so you get into a situation here where some of this economic data might actually be more impactful because of a sort of overlay of slightly less participation as we on-ramp into the end of the year than would be the case usually. So with that in mind, the first bit on the calendar to look at here is German inflation data. And this might be very important, not only because of its implications for the euro, not only because of its implications for European stocks, but because of its implications for how markets are thinking about economic data here, be it something that comes out of Europe or elsewhere. Now, the expectation is that inflation in Europe will continue to decline. We can see here the headline number expected to come down. This is the harmonized version of German CPI, the one that's the most relevant for the ECB. Germany releases a CPI data set that is sort of their own domestic data set, and then they release this harmonized one, which mirrors the way that these numbers are constructed for the whole of the Eurozone, and that sort of gives the ECB a single yardstick with which to measure dynamics. So this is the one that seems to be the most potent one to look at from the central bank's perspective, and therefore the most market moving. And here we're looking encouragingly at perhaps seeing headline inflation come down into the 2.5%. That would be the lowest that we've seen it since the middle of 2021. So ostensibly an encouraging data set. The fly in the ointment here is that last week we saw a set of PMI numbers, purchasing manager index numbers, out of both Germany and the Eurozone that suggested inflation actually picked up in November. Which is a bit of a risk here. Now, if we look at the way that economic data in the Eurozone has been performing lately, it's been pointedly improving relative to forecasts. Now, that doesn't mean the data has been good. As a matter of fact, Europe is almost certainly in a recession already. It just hasn't been as bad as expected and is increasingly getting better relative to those expectations. Now, it's still tending to undershoot those expectations, importantly. This index is still below zero. But the margin by which that is occurring is pointedly shrinking, which seems to lend credence to the idea that maybe we get something of an upside surprise here, even modestly so. The key question, of course, is going to be, to what extent does this impact the ECB calculus? We can see here at this point, we're looking at about a 57% chance of the first cut occurring in April, and then that cut fully baked in by the time we get to June. There is, from the looks of it, about 3 cuts overall on the menu for next year. By October, we get to 2, with a 77% chance for a third, which means that by the time we get to December, we're probably looking at that third occurring. That seems to be the baseline for the markets. If we get a hotter CPI number, we might get the likelihood in April worked down a bit. We might get scope for 3 reduced a bit into perhaps something closer to maybe 2 with some optionality for a third. And so the question critically will be, how does this influence the euro and how does this influence assets in Europe? Because this is not, as it might normally be, an easy answer. Now, we can see here, since the last time that the ECB met on October the 26th, the shift in policy expectations has been in the dovish direction. So we can see the current curve in the solid line is pointedly flatter, especially from the 6-month mark outward, than the one that was there on decision day in late October. So clearly, ECB policy expectations have been shifting in a more dovish direction since the meeting, but the response from markets has been not what you might expect. Typically, if you get a dovish shift in policy expectations, the currency weakens because the yield that is then gettable on that currency is lower and it becomes less attractive. Similarly, you might see a negative response in other related assets. But here's what we've seen. The euro has actually increased since that meeting. So as policy expectations have been moving in a more dovish direction, the euro has actually gone higher. And some of this thinking seems to match up with a thought we've been pondering here for 6-7 weeks here on macro money, which is the idea that the market will, as rate expectations stabilize and the pendulum shifts from hiking to cutting across all of the major central banks, the thinking will become, where will the stimulus come soonest? That's the place where risk appetite should be greatest. That's where capital ought to go, because if everyone has stopped hiking, then the growth will rebound faster where it has perhaps been the most downbeat, Europe, and where the central bank might be fastest to provide relief, perhaps then also Europe. And so what we've seen is, since that same meeting, European stocks have surged and have outperformed the U.S. benchmark, the S&P 500, by somewhere on the order of 3 percentage points. So the underlying capital flow out of dollars into euro seems to have been catalyzed by a more dovish ECB, not the other way around. Here is where that German number gets so interesting. If we were to get a higher inflation number, would the euro cheer? Because rate cuts might be delayed and so it might have a greater yield appeal? Or would the euro actually decline because stimulus might be more distant than earlier expected, and so some of the capital chasing European assets, namely stocks here, this is the EZU ETF, which is a tracker of the Eurozone MSCI index, a benchmark of Eurozone stocks. If that capital rotation takes a bit of a hit and local stocks pull back, that might be something that actually hurts the euro in a counterintuitive fashion. Where this is important is very much in shaping the lens for how markets are currently interpreting any kind of economic data. If they've concluded that everybody is going into a recession holding hands, and there is no relative appeal to hiking versus cutting, and the thing to prize at this point is where the stimulus will be soonest, because that's where growth will rebound fastest, then the markets might reward a more dovish policy approach and data that supports it, be it out of Europe or elsewhere. Whereas if you might get a different story, if you get data encouraging a less dovish approach, well, then that might be bad for both the currency and the underlying assets, if that's the lens through which markets see this now. And very shortly after we get this test with German CPI, we are going to get a very similar dynamic, only this time coming from the world's second largest economy in China. This is the next big announcement on the week. We're going to get this data piecemeal. The official data set here out of the CFLP, the China Federation of Logistics and Purchasing, that's the official government organ that publishes PMI data in conjunction with Beijing's National Bureau of Statistics. That's going to release manufacturing and service sector and composite PMIs this week. We're also going to get a competing data set, this one from the private sector. Caixin and S&P Global put that one together. They're going to release the manufacturing numbers this week, and then service sector and composite will come out over the weekend. So we're going to get this data over the coming days in pieces. But when we look at them together, the expectation is China's economy remains basically at standstill. A slight pickup in official data led by services expected. Similarly for the Caixin numbers, a slight uptick expected, again, powered by a slight increase in services activity. Manufacturing still seen as shrinking for the third consecutive month now in both data sets. And so the question now is, okay, so China's economy is at a standstill. It's been near standstill for months at this point. What is likely to happen here in this data that is going to upset the apple cart? And if we look at the way Chinese economic data has performed relative to forecasts, we can see in an even more emphatic display than we just saw in Europe, from about the middle of July, Chinese data has been getting better compared to expectations, and now isn't just underperforming by a smaller margin, but is now actually outperforming relative to forecasts. So analysts' models are at this point more pessimistic than reality is validating. And we can see it in short order. So just as from about the middle of July, data has improved relative to forecasts, so too we can see, looking at GDP forecasts for China, they got downgraded, shock of shocks, mid-July and into the second half. So we get this sense that expectations have been pulled down, and that's why data is having an easier time beating them. So the question then is really, if this is going to be how this goes, and the data out of China is not necessarily good, as a matter of fact, again, pointing to standstill, but if it is just not worse than expected, and indeed the trend has been that it's marginally better, then we might see continued optimism just because all of the bad news has ostensibly been priced in already. And because Chinese stocks have vastly underperformed their U.S. counterparts this year, you might yet again have some scope for catch-up. If we take a look at the way these things have performed so far from the bottom in October alone, never mind the rest of the year, we can see that Chinese stocks have rebounded relatively significantly, but the move elsewhere has been much more pronounced. So European stocks already have this catch-up rally. They're up 13% from the lows in October, whereas those in the U.S. are up 11%. Chinese stocks are up less than 1.5%. Now, if we look at the full year here and we consider where things have underperformed versus outperformed, the U.S. has vastly outperformed its counterparts. As a matter of fact, the S&P is up 18.5%, almost 19%, while stocks in China are actually down 10% on the year. And so we get into a situation where if the stock of bad news has been exhausted and there are no meaningful reasons to keep selling, there may be a catch-up rally on those grounds alone, which again makes the stage-setting exercise with German CPI that much more important to see what it is that markets are rewarding in this current environment. Finally, the last bit of notable data here is going to be the U.S. PCE inflation index. Expectations here for a slight downtick, down to 3.5% on the core reading, which is the one that the Fed cares about most acutely. So a slow move in the Fed's direction ongoing here. And the response dynamics at this point are very clear-cut. So we can see here that from mid-year through to about October, we saw a very clean sort of pattern here where the gray bars are the amount of rate cuts expected between December of this year and December of next. And as we can see, with the receding banking crisis and debt ceiling debacle at mid-year through about October, the rate cut stock was getting less and less aggressive, so fewer cuts from about 1.75 to as little as 1. And as this was happening, the prospect of higher rates inherent in fewer cuts was driving stocks lower. When the trend actually turned and we started to expect more cuts, stocks rose. As you can see, we're building out these cut numbers once again. It was a parallel story in the US dollar where fewer cuts meant a stronger dollar, and now more cuts mean a weaker one. And so the dynamic has been fairly straightforward. And the question that we ask ourselves then is this PCE number likely to alter this calculus in a meaningful way? Here's what the situation looks like at the moment. No further hikes from the Fed, 56% chance that we get the first cut in May, so just a hair better than even. That cut fully baked in for June, and about a 36% chance that we get a full percentage point in cuts by December. But as it stands, 75 basis points in cuts all the way baked in, and then we get into a conversation about perhaps a fourth one into early next year. As long as this is not upset by whatever happens on this data, we are likely looking at more of the same. Indeed, if we look at the way U.S. economic data has performed relative to forecasts, we can see here it's actually tended to increasingly soften relative to expectations. And in a mirror image of what's going on in China, it's in large part because from about the middle of August, expectations for U.S. growth have been marked up. So it's been easier in China for growth to beat forecasts because the forecasts got cut. It's been harder in the U.S. for data to beat forecasts because they got raised. And so that continues to be a dynamic here and seems to give the possibility that indeed this data might actually register a little bit softer than expected, which, as it happens, is exactly the conversation that we had with the analogous CPI data for this same period, which already came out. It registered a hair weaker than expected, so 4 on the core rather than 4.1, 3.2 on the headline rather than 3.3. Very modest differences, as a matter of fact, compared to forecasts, but the response from markets was emphatic. We saw a dramatic positive response from stocks, a positive response from bonds, a sharp sell-off in the dollar, and the logic seemed to be, well, this doesn't change the calculus, but it is event risk getting out of the way. allowing us to then move on with what we were going to do anyway, which is to price for this world where Fed rate hikes have ended. And so, to that extent, if we get a PCE number, which, like the CPI counterpart, is a touch softer, well, then all these familiar dynamics kick back into play. And once again, looking at that German CPI number for a bit of stage setting becomes critical. Because if that one works again to tell us that more stimulus is a thing the markets are welcoming, be it for the currency or be it for the stock, as long as that currency isn't the dollar, of course, which is the go-to anti-risk form of cash, then we might indeed be looking at a situation where, as long as the expectations at the baseline are not upset, more of the same is in store, which is a kind of settling into a world where central banks are done and risk is on that premise, and really that premise being not violated and the data being not any worse and not any more detrimental for that idea than anticipated is enough to allow it to have continued life. And that is Macro Money for today. We're back to our normal post-holiday regular scheduling. So we'll be here as ever Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, where we look at what happened on Wall Street on a given day and try to figure out what it means going forward. I'll be on with Chris again for Futures Power Hour on Sunday, or on Friday, rather, with Tom and Tony, rather, on Sunday for First Call, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilias Pivac. Thanks very much for joining. We'll be back with more Macro Money tomorrow. Happy trading.